Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, good morning, everyone. So today's workshop, we're going to look at some more examples of credit default swaps, and we're going to look at total return swaps, okay? All right, so the first example is about this credit default swaps. So let's read the question first, and let's think about who owns who the money, okay? So we have a buyer of the CDS and a seller of the CDS. Let's figure out. So the question says, suppose the two parties entered this 5 years credit default swap on 20th of March 2012. The notional principal is 100 million. And the buyer agrees to pay 90 basis points per annum for the protection against default by the reference entity. Right? So we talked about this on Monday. So reference entity can be the company who issued corporate bonds. Right? So for example, General Motors. General Motors would have issued corporate bonds, and you can buy the corporate bonds from US corporate bond market. So once you bought corporate bonds, you're worried that the General Motors could default on its debt. Then what you can do is you can enter into this credit default swap. So basically, this credit default swap is for the protection against the default by the reference entity. So you can think of a company like General Motors. And then it says the payments being made in quarterly, in arrears. All right? So remember on Monday's lecture that the buyer of the CDS needs to pay the seller the annual payment. An annual payment is made in arrears. But in this example here, it says the quarterly payment, and the quarterly payment is made in arrears. And then it says, assume that the reference entity missed a coupon payment on its outstanding corporate bonds, and the bracket explains that if missing a coupon constitutes as triggering a credit event, okay? So that triggers a credit event on 20th of March 2015. The cheapest delivery bonds is worth $25 per $100 face value. On the International Swap Derivative Association organized auction 3 days after the credit event. And then the question says, please detail the cash payments that the buyer and the seller are supposed to pay each other for the cash settlements of this CDS contract. So basically, in Monday's lecture, we learned the two ways you can settle a CDS if the reference entity default on its debt. The first one is physical settlement, and the second one is the cash settlement. So this question specifically asks you to detail the payment through the cash settlement. Okay, so before we do that, let's figure out how much the buyer is supposed to pay sellers, okay, if the reference entity had not default. So here is the diagram, all right? So remember, the CDS contract is, if you like, it's an insurance contract. All right, so this insurance contract protects you against the risk of default of the reference entity. So just imagine the reference entity in our example here is General Motors. All right, so here is the situation that if General Motors never defaulted on its debt. Now, if there's no default, if there's no credit events, then the buyer receives no payoff. Right? So the buyer of the CDS will receive no payoff because there is no default. And on the other hand, the buyer is supposed to pay the seller of the CDS 90 basis points per annum. And that payment is paid every quarter in arrears, which means there's 1 quarter lag. Okay? So 90 basis points per annum goes to the seller, and as a return, what the buyer gets is the protection, right? The protection against the default by the reference entity. Now, if it's made quarterly, so that's 90 basis points divided by 4, so that's 22.5 basis points each quarter. And that is multiplied by the principal, which is 100 million, right? Okay, so basically this contract is entered on 20th of March 2012, right? So 20th of March 2012, then the payment, the first payment will be on the 20th of June 2012, right? So that's the first payment. So the first quarter, there's no payments, and the first payment starts in the second quarter, okay? then the payment is made each quarter in arrears all the way up to 20th of March 2017. So that's the situation where there's no default. But the question specifically says that the reference entity, for example, General Motors, missed a coupon payment. So if the reference entity missed a coupon payment or cannot make the coupon payment in the full amount, sometimes it's considered as the technical default, which means although the reference entity has not actually filed a bankruptcy, but is constituted as a financial distress event, okay? That's constituted as an credit event, which is a technical default. So it says, missed the coupon payment on the outstanding debt on the 20th of May, 2015. Okay? And as I mentioned, if that happens, then the seller of the CDS need to make a payoff to the buyer, right? And the payoff can be made in two forms. The first form is the physical delivery, and the second form is the cash settlement. So physical delivery is simple. Simply, the buyer of the CDS has the right to sell the bond to the seller for the face value of the debt, and the seller is obligated to buy this troubled bond for its face value. However, this question specifically asks detail the cash payment while the cash settlement, right? So with the cash settlement, the first step is let's find out how much the buyer of the CDS can recover from this troubled bond, right? The recovery rate from this bond. The way that people find out the recovery rate of those troubled bonds is through an auction, right? So basically try to determine what's the market value of this bond. And the question says, through this auction, we found out that we can recover $25 per $100 face value. So that's 25% recovery rate, right? Basically, the buyer still managed to salvage 25% of the face value of the debt. Now, if that's the case, then the seller should compensate the buyer the remaining principal, so which is 1 minus 25%, right? So here I have equation here. So this is the equation here. So basically, Q is how much we can recover from this auction, which is the market value of this troubled debt. And 1 minus that give us 75%. Right? So that's the remaining amount that the seller needs to compensate the buyer. So the principal is 100 million. So that's 75% times 100 million. And the seller of the CDS needs to pay buyer 75 million to compensate the buyer of the CDS upon this credit event. Okay? So that's how much the seller owes to the buyer. But the buyer also owes some money to the seller, right? Why? Remember, all of the payment is paid in arrears, right? So a final accrued payment from the buyer to the seller is still needed. So let's figure out how much the buyers owe to the seller of the CDS. So in the question, it says the credit event took place on the 20th of May, and we can see the timeline from this diagram here. So 20th of May, that's basically 2 months into the fourth year, right? So that's the 2 months into the fourth year. Now, if that's the case, and we know what's the quarterly payment, right? So we're supposed to pay 90 basis points per annum to the seller. So that divided by 4, we need to, and that times the principal, we need to pay 225,000 every quarter in arrears. And that because it's defaulted on the 20th of May, 2015. So that's 2 months into the fourth year. So basically, we still own 2/3, right? So 2/3 of the quarterly payment to the seller. So that's the quarterly payment times 2/3. So the buyer still owes 150,000 to the seller. And once the buyer pays seller 150,000, then this credit default swap is settled. Okay? So let me say this again. The question asks you, detail the cash payments that the buyer and the seller are supposed to pay each other. So basically, we determined that the seller is supposed to pay buyer 75 million, and then the buyer still owes seller 150,000, because 150,000 is the accrued payment prior to the default. Does that make sense? Any question with with the first example. Okay, so this question says, what is CDS bond basis? And the second part I ask you, why should excess N-year of bond yield over the risk-free rate should be approximately equal to N years of CDS spread? Okay, so to answer the question, what is CDS bond basis, let's think about these following examples. Okay, so let's just imagine an investor who bought a corporate bond, and this corporate bond provided yield of 7% per annum for the face value. Okay, so at the same time when this corporate bond holder bought the corporate bond, at the same time, this corporate bond holder also entered into this 5-year CDS, right? So when you buy the corporate bonds, the bondholder buy the CDS to get some protection against the probability that the issuer would default on its debt. Okay, so let's assume the corporate bond has a yield of 7%, and CDS spread, so CDS spread is like the insurance premium you pay to the seller to get this protection. So the CDS premium is 200 basis points, right? So 2% per annum. So what is the net return this bondholder gets? Let me say this again. So the bondholder bought this corporate bonds, and this bond provided yield of 7% per annum, and the buyer also pays 2% per annum to get the CDS protection. So what is the net return to this buyer? 5%, right? So you earn 7%, you pay out 2%, the net return is 5%. Okay? And if you bought a CDS at the same time you're holding a corporate bond, what are you doing? You're basically converting a risky bond into a risk-free bond, right? Because there's only two scenarios can occur. Either the issuer never defaulted, so you hold this bond to its maturity, and you get the 5% return throughout the holding period, right? 5% per annum throughout the holding period. That's the first situation. Even if the bond defaulted, that's okay, because the seller would compensate you, right? Let's say if it's a physical settlement, then the seller would just buy the bond from you at its face value. Then once you get the money, you can reinvest that money into a risk-free security. So either way, buying a CDS is effectively converting this risky bond into a risk-free bond. Okay? So if that's the case, then we should expect that the CDS spread minus the excess of the bond yield over the risk-free rate should equal to 0. Does it make sense? So, okay, so let me elaborate on this. So basically, okay, so basically we can make an arbitrage argument here. Why this should be the case? Why the CDS spread should equal to the excess bond yield over the risk-free rate? Now, if this equal to 0, CDS bond basis equal to 0, effectively we can rearrange this equation. We can get this equality here, right? Let's assume the CDS and the bond basis should be 0. Then we should have CDS spread equal to the excess bond yield over the risk-free rate, right? So this equation should hold. Okay, so let's imagine if the CDS spread is smaller than the excess bond yield over the risk-free rate, what happens? So effectively, you can think this situation as the risk-free security is the one that's underpriced. Okay? The investor can do something today to earn a return that's more than risk-free rate by simply buying the corporate bond at the same time and buying the CDS protection. Okay? So by doing that, you're synthetically creating a risk-free security and earning a return that's higher than the risk-free rate. So that's one way you can think of that. Now, the alternative situation is where the CDS spread is larger than the excess bond yield over the risk-free rate. And now, if the CDS spread larger than the excess bond yield over the risk-free rates, that means we have a very high risk-free rate of return here. So that's why when you're using the bond yield minus this very high risk-free rate, this whole component is smaller compared to the left-hand side. Okay? So if that's the case, investor can do something today to synthetically borrow, to finance at a risk-free rate that is less than the actual risk-free rate. So how can the investor do that? So basically, investor can short a corporate bond at the same time selling a CDS. All right? So if the investor do that, then the investor is borrowing at a rate that's lower than the prevailing risk-free rate. So, and that would have same effect if the borrower is financed at a risk-free rate. Does that make sense? Any question on this? All right, so actually this strategy, so this CDS bond basis strategy has been used in the industry. So before 2007 financial crisis, this CDS bond basis was actually slightly positive, all right? So we argue on average this should be zero. Basically, CDS spread should equal to the excess bond yield over the risk-free rate. But before the financial crisis, this basis was actually slightly positive. Then in the post-crisis period, then the CDS bond basis is actually on average negative, all right? And so in the post-financial crisis, what we have observed is that U.S. mutual funds, especially U.S. mutual corporate bond funds, engaged in this negative basis trading strategy, right? So if it's negative basis, that means we should loan the corporate bond at the same time loan the CDS, right? So negative basis means that the left-hand side is smaller than the right-hand side, right? So this is smaller than that. Then we have a negative basis. So what's this negative basis trading strategy all about? So mutual funds, especially for those mutual funds that specialize in corporate bond market, they are actually highly regulated, all right? So because the government think they have a very high systematic risk, right? So they cannot afford for those mutual funds to belly up. If those mutual funds get into financial distress, then they have ripple effect on other mutual funds. So basically, those mutual funds who specialize in corporate bond market are highly regulated. So they cannot take excess amount of risk. In other words, those mutual funds cannot invest huge amount of their capital in below investment grade bonds, right? So basically, we have investment grade bonds. So those bonds with very good credit rating, and then we have speculative bonds, also known as the junky bonds, right? Junk bonds. So junk bond is below investment grade bonds. Okay, but one appealing thing to the mutual fund is that those below investment grade bonds actually has a very high yield, right? Because they're risky in nature, so they need to provide a high yield to attract investor. And this is especially so after the financial crisis because we know there are 4 quantitative easing programs implemented by the Fed, right? So after the quantitative easing program, we see that there is a very high yield in those speculative bonds. So basically, there's a situation where the mutual fund wants to invest in those speculative bonds, and they don't want to run into the regulatory risk, right? So what they did is they buy the bond with the high yield, at the same time buy the CDS, because the government allowed the mutual fund to buy the risky bond at the same time buy the CDS, because having the CDS, effectively you're converting this risky bond into a risk-free bond, right? So if you do that, then that's okay. You can still invest in speculative bond as long as you are insured. So what they did is they bought the bonds, at the same time bought the CDS, so they're holding a risk-free asset, and then they are earning then above average return because of the high yield that generates on those speculative bonds. Okay? But then if you have a closer look as to why the speculative bonds provide such high yield, first is that they have very low credit quality. So that's to compensate additional risk. But if the market is perfectly efficient, then those additional premium should all be subsumed by the CDS spread, right? So all of the credit premium that you earn on those risky bonds should be purely observed by the price that you pay to buy the CDS. So that's the efficient market. However, the reason why those mutual funds can still earn above average return is because there's additional premium that's embedded in the bond yield is to compensate for the illiquidity of the corporate bond. So basically, unlike the stock market, the corporate bonds are thinly traded. So there's not much trading in the corporate bond market. Now, in order to compensate for that, those speculative bonds need to offer even higher yield to compensate for the illiquidity premium. But that's okay for the mutual fund because mutual fund is effectively buying and holding investors. So they are not trading the bond day in and day out. So they don't actually need that liquidity. So as long as there's no credit risk, then the mutual fund is fine. So that gives birth to this yield enhancement strategy called a negative basis strategy. Basically, you buy the corporate bonds, at the same time you buy the CDS. You enjoy the high yield that compensates for the illiquidity premium. At the same time, you are not taking excessive amount of credit risk. Okay? Just for your interest, I thought this is a very interesting strategy. Any question on the CDS bond basis? Okay, so then let's have a look at the next example, which is total return swaps. We kind of touched on this total return swaps. But today we're going to view the total return swap as a different sort of financing tool. So not only the total return swap can be viewed as a hedging tool, and also it can be viewed as a financing tool. Okay, so basically, as I mentioned in Monday's lecture, the first reason why people enter into the total return swap is try to diversify their loan book, right? So if I specialize in certain industry, I would like to swap some of my loan return with some other bank's loan book just to get some diversification benefit. That's one reason people enter into total return swap. The other reason is people probably have different point of view in terms of the direction of the market. So some people might think the risky fixed income security is going to underperform, and they would like to swap their current position with a risk-free position. And some people who is currently holding a risk-free security might think that the risky bond market will do well in the near future, so they would like to swap their risk-free position into a risky position. And this example here illustrates that. So the question says, suppose that the total return swap is a 5-year agreement with a notional principal of 100 million to exchange the total return on a corporate bond for LIBOR plus 25 basis points. Okay, so you can think of this LIBOR plus 25 basis points as the risk-free return. Okay, and the total return on a corporate bond can be viewed as the return from a risky fixed income security. So one thing is worth mentioning is that the total return not only including the capital gain and the loss that you get in the corporate bonds, but also plus the return from the coupons. So the total return has two components. One is the income return, the other one is the capital return. Okay, so the total return includes both the return from the coupons as well as the return from the capital gain and losses from holding this corporate bonds. Okay, so how does this total return swap work? So basically, the payer would pay the coupon earned on this 100 million worth of corporate bonds. So basically, this payer invests 100 million in this corporate bonds, and then the payer needs to pay all of the coupons to the receiver. Okay, so basically, if you like, you can think about the payer is the one who is holding this risky position, and the payer just pay all of the return that he gets from this risky investment to the receiver. And the receiver is currently holding in a risk-free position, and the receiver is paying all of the risk-free rate of return to the payer. Okay, then the receiver would pay the interest rate of LIBOR plus 25 basis points. All right, so basically, if you like, the receiver would like to get into this risky bond, and the payer would like to get into this risk-free position. Okay, so then to the end of the life of this swap, you also need to swap the capital gain and losses. Because before the maturity, all this swapping is the return on the coupons, right? So coupon is only one component out of the total return. And then we also need to do something about the capital gain and loss on the bond. So there are two situations at the end of the life of this swap. So basically, the first situation is that the bond appreciates in its value. Okay? So if the bond increases in value by 10%, then the payer owes money, then the payer owes money to the receiver, right? Because the payer is supposed to pay all of the return on this bond to the receiver. So if the bond appreciates in value, then it turns out the payer is owing the money to the receiver. So the payer needs to make a final payment. What's the final payment? Which is this 10% appreciation times the principal, which is 100 million. So that's $10 million. So the payer needs to make this final payment, $10 million at the end of year 5 to the receiver to settle this total return swap. So that's when the bond has appreciated in value. What if the bond decreases in value? Let's assume at the end of the life of the swap, the bond decreases in value by 15%. Then the receiver owes money to the payer, right? So the receiver is required to pay $15 million, which is 15 times 100 million, to the payer at end of year 5, if the bond has depreciated in value. Okay, what if there's a default on the bond? Well, if there's a default on the bond, then similarly, receiver is owed money to the payer. So the receiver would make a final payment that would equal to the difference between the face value of this 100 million and the market value of the bond at the time. So basically, the market value you can think about how much value the people can salvage from this troubled bond. And then the receiver needs to make the difference between the face value and the market value of that troubled bond to the payer. Then this swap is settled. Does it make sense? Does it make sense why the receiver is paying the payer if the bond has depreciated in value? Now, if you think this way, receiver is the one who is receiving all the benefit from this risky bond, right? Now, if the bond has appreciated, of course, the receiver benefit from that. Now, if the bond has depreciated, then the receiver is worse off. If you think that way, you understood why when the bond decreases in value, then the receiver is owed money to the payer. Okay? And vice versa, if the bond has increased in value, then because the receiver is the one who is receiving the benefit from the bond, so the payer owes money to the receiver. So payer needs to pay the amount of this appreciation component to the receiver to settle this total return swap. Would that make sense? Any question on this total return swap? Yes? Yeah, so basically default is, you can think of that as similar situation to the bond had a huge depreciation, right? If you think that the bond is worthless after the default, all right? So if you think the bond is worthless after default, that's basically the bond value decreased to 0. So it's just extreme case of the bond's depreciation. Now, because the receiver is the one who's supposed to receive the benefit from this corporate bond, and if the bond decreases value to 0, then receiver owe money to the payer. Does it make sense? And if the bond is worthless, worth nothing, then what receiver owes to the payer is the face value of the bond. So receiver needs to pay the payer the face value of this bond to compensate the payer. Because after the swap, the payer is supposed to end up in a risk-free situation, remember? Because the payer is the one who is receiving all the risk-free rate of return. So the payer not supposed to be subject to any risky situation. So if the bond defaulted, then the receiver basically need to compensate the payer the face value of the bond. In that situation, you can view this as a CDS contract, right? So when a reference entity defaulted, the seller of the CDS is obligated to buy the troubled bond from the buyer of the CDS at its face value, and effectively, this is the same situation. It's just the receiver this time is the one who sold that CDS, and the payer is the one who is buying the CDS. Would that make sense? Okay. Yeah, so the best way to think about default is just to think about default as extreme case that the bond had a huge, decrease in value. Okay, which would be saying in this situation, then the receiver ought to compensate the payer. It's the difference between the face value and the market value of the bond. So the example I just gave you is the extreme case. If the market value of the bond is worth 0, then the receiver need to compensate the payer the face value. Now, if the bond still worth something, then the receiver needs to compensate the difference between the face value of the bond and the market value of that bond, right? Because the payer can still recuperate some of the loss from selling that troubled bond in the market for whatever value they can recover. Would that make sense? Okay, good. Any other questions on total return swap? All right. Now let's think about total return swap has some other purpose. Okay. Now, if you think about the payer, I just give you an analogy as the total return swap can be viewed as a CDS contract. But the total return swap can also be reviewed as a relationship between lending the money and the borrower is pleading a collateral to the bank. So let me give you this analogy here. So just imagine the payer is the bank. Okay, so the payer is the bank. Who can lend out money to some mutual funds. All right. So imagine the receiver is the mutual funds. All right. So the receiver, the mutual funds, would like to borrow some money and then invest in a corporate bond to earn some money. And there are two ways you can do it. The one way is through the traditional way, which is the mutual fund goes to the bank, said, can I borrow $100 million? Then I'll make the interest payments. And the bank said, that's fine. If you want to borrow that much money to invest in a risky asset, you better give me some collateral. Everybody understand the collateral, right? So the collateral is some asset that you need to give to the bank to make the bank become a secured lender. Okay? So that's the traditional way. The mutual fund can borrow money from the bank and use the bonds that they invested as the collateral and give to the bank. In case everything goes south, the bank can still recover some of his money by selling that troubled bond in the market. Okay, so that's the traditional approach that you can do it. And the alternative approach is for these two parties enter into this total return swap. Okay? So basically, instead of for the payer to lend money to the receiver, the bank, can simply invest in the bond himself and then give all of the benefits that the bank got from the bond to the receiver. And then the receiver is repaying this loan, okay? So LIBOR plus 25 basis points. That's the alternative way that the mutual fund can finance to invest in the corporate bonds. Because ultimately, the mutual fund borrow money, invest in the corporate bond, is try to get exposure to the corporate bonds, right? Now, if you're already paying over the total return on the bonds, it's almost as if the receiver is himself is investing in the corporate bond. It's just that the ownership still remains with the payer. So the ownership remains with the bank, right? So the bank has the ownership. So why this is a better alternative than the traditional approach, which is to go to bank, take out the loan, invest in the corporate bond? Well, that's because the bank can get more recovery rate out of this corporate bond. In the traditional approach, if the bond is used as collateral by the mutual funds, give to the bank, then if everything goes south, then the bank needs to fire sell the corporate bond. If you fire sell an asset, then the asset would take huge haircuts, huge discounts, all right? Huge depreciation in value. However, if the bank get to retain the ownership of the bond, the bank can simply hold that bond to the maturity, all right? So, or maybe they can sell it with more time, so they don't have to do the fire sale thing. So basically, in that situation, the bank can get more recovery rate out of the collateral. Does that make sense? Does that make sense? So basically, in the second situation where these two parties entered into this total return swap, the bank get to retain the ownership of the covered bonds. Unlike the traditional approach where the ownership stays with the receiver, stays with the mutual funds, then the bank have to try to sell that collateral at a fire sale price, which has a huge discount effect on the asset itself. Any questions with the total return swap? So that's just basically what I mentioned. The borrower gets to retain the ownership of the bond for the life of the swap, and the borrower faces less credit risk than you would have been done if it had lent money to the receiver to finance the purchase of the bonds, with the bond being used as the collateral for the loan. All right? If the receiver defaulted on the commitment, then the payer does not have to have a legal issue to try to realize this collateral, because this bond's ownership automatically belongs to the payer, belongs to the bank. So the bank has no problem trying to realize this collateral. Okay? So that means less risk for the bank, and the mutual fund can still get the same benefit as if he borrowed money from the bank and invest in the covered bond himself. Just go home and think about this a couple more times, then it would make sense. All right, so the last example, which is an insurance derivative. So this question says an insurance company losses of a particular type are to reasonable proximity normally distributed with mean of 150 million and a standard deviation of 50 million. And this bracket basically assume we're living in a risk-neutral world. Basically, you can discount with risk-free rate. And we were told risk-free rate, the one-year risk-free rate is 5%, and the estimate cost the following. So there are two parts to this question. So the first part says a contract that will pay in 1 year's time 60% of insurance company costs on a pro rata basis. So what does this mean? So that means the insurance company is not bearing the full risk. The insurance company is reinsured with another reinsurance company, okay? And that reinsurance company needs to pay the insurance company 60% of the damage claim if there is an earthquake or hurricane. So that's basically what it means. And we will ask to estimate the value for that particular contract. Okay, so how can we do that? We can do that because we already know the distribution of that particular type of disaster. If that has an average damage claim of 150 million, if that event occurs, then on average the insurance company needs to pay out 150 million, and it was the standard deviation of 50 million. So that's what the distribution looks like. And then the reinsurance contract only responsible for 60% of that, right? So 60% of 150, that's 90, and 60% of that standard deviation is 30. So basically, that's the distribution to the reinsurance company, which has, on average, need to pay out 90 million to this insurance company in the event of an earthquake or hurricane. All right? But that's paid out in the future, right? That's paid out in the future when that disaster happens. And we're pricing this contract today in the risk-neutral world, so we simply discount back to the present, right? So we simply discount back the 90 back to the present using the risk-free rate. So basically, that contract is worth 85 million. So that's the value of this contract. If the reinsurance company needs to sell a contract to the insurance company, that's how much the reinsurance company needs to charge. And we need to have a look at the second question. So the second part says, imagine this insurance company pays 100 million in 1 year's time if the losses is greater than 200 million. Okay? So one of the tips we'll get from the question is that this loss is normally distributed. Okay? Then we can use our normal distribution. So effectively, loss is greater than 200 million is this area to the right. So this area to the right gives us the probability if the damage claim gets above 200 million. All right? And we know how to do that. We can calculate our z-score. So we know that's 200 million, right? Greater than 200 million. And this distribution has a mean of 150 and a standard deviation of 50. All right? So we just standardize this. We get a z-score is 1. So 1 gives us the area to the left, okay? So let's find the area to the left first. Then 1 subtract that probability, give us the probability that the losses would get above 200 million. Okay? So if we go to our table, we find that the 1 is corresponding to a probability of 84.13%. Then 1 minus that is 15.87. So 15.87 is the probability that the losses would get above 200 million. All right? And so that's the probability of that scenario occurs multiplied by the payoff, right? So if the losses exceeds 200 million, the reinsurance company ought to pay the insurance company 100 million. So that's probability of that occurrence times the payoff, then that's 15.87 million. And again, we need to discount that back to the present. So we discount that back to the present, then this contract is worth 15.10 million. Okay, just one little example with the insurance derivative. Any question with this? All right, so we are done for the entire course. So finish everything you need to know to do the final exam. And next week, this hall will be utilized by the music concert. So we have a different location. So that location is in Cambridge Cinema Theater. So I'll post it on Woto. So next Monday, we don't have a lecture. The lecture is on Thursday afternoon, and we don't have workshop next week, only lecture. And what I'm planning to do in the revision lecture is to go through some past exam question with you guys and answer some queries from you guys. Basically do a quick revision of the entire course and give you a feeling, what needs to be emphasized when you're doing the revision yourself. All right? Okay, so that's all for today. Thanks, guys.